This video is part of the ICT Trading Setup for Life series, where I go over setups and strategies that ICT recommends in one of his videos titled ICT Trading Setup for Life. I'll be covering 3 setups in the series in a simple way, so make sure to watch the other videos. This video, I'll be going over the London session sweep model, and I'll be showing you how to make money using this model. If anyone needs a one-on-one mentorship, check out the description. This is Mulham, and let's get into it. So today's setup is very easy yet very effective. It's so similar to the Asian session sweep, my favorite strategy in Forex. So instead of using the Asian session, we're going to be using the London session highs and lows in this case. So as usual, starting with a pair, I would say this would be mainly on indices, yet it can also work on Forex. I know that it can work on Forex. Why? Because it's a previous session high or low. So it's the same, but ICT recommends using this on indices and mainly S&P 500, but you can still use it on Forex or indices. So starting with the strategy here, what do we look for? So the first step that you're going to do is mark 2 a.m. and mark 5 a.m. This is the London session timing. So the highest high between 2 and 5, we mark this high, and the lowest low, we also mark it. This would be our high and low in the London session. And this should be on the extended trading hours or the electronic trading hours. This shows all of the overnight trading. If you just have the regular trading hours, you will not see this chart. So make sure that you are in the electronic trading hours. And we'll be marking, as I said, the highest high and lowest low between 2 and 5. And we wait for 9:30 or 10, and we wait for the sweep of either the high of the London session or the low of the London session. If the bias is to go down and we take the high of the London session, that's a high probability setup. However, if we're really going up, if the bias is going up and we have the London high taken, then it's not going to be that high probability. Why? Because there's not going to be a liquidity sweep, but it's going to be a breakout or breakout structure to the upside. So we got to be aligning this with the bias. If we are in a bullish market, we want the low of the London session to be taken, then going up. And the opposite, if I'm bearish on the market, I want the London high to be taken, then going lower. So after identifying the bias and the draw in liquidity, or simply the order flow even from a single time frame, I'll be waiting for 9:30 for the market to open, and 9:30 or 10 to 11, which is the silver bullet timing, I'll be waiting for price to take the London high, no displacement here. Another time it's taken and taking this high too. And then we have a market structure shift displacement with a fair value gap. We can simply enter from the fair value gap. Or you could be using any type of entry that you prefer. So if you prefer a breaker block with a fair value gap, you can do that. If you just prefer a breaker block, if you like using inverse fair value gaps. So as I said, go with whatever you prefer. Now we enter here on the fair value gap. What do we target? We first target the London low. If it's giving us a good reward to risk, we target the London low, and then we can extend them more. But there are some times where there will be a big reaction from the London low. So it's a very easy model. We are just focusing on some specific times liquidity. When taken, we look for any type of entry on the other direction. Now, if you need to understand this more, make sure to stay until the examples where everything is going to be more clear, as well as looking at my Asian session strategy. It's very similar to this one. Today's video is sponsored by Hanko Trade, one of the best brokers in the business with spread as low as 0, low commission, and you can trade all markets, including Forex, indices, and crypto. And if you use the link in the description, you will get an exclusive 100% bonus. Make sure not to miss it. Let's get back to the video. Now going over the steps in a written way, that's to make it clear. So we first identify the bias and the draw on liquidity. That's the first step in any model. Any model, if you want to raise the win rate, you got to do this step. Then we mark the highest high and lowest low between 2 a.m. and 5 a.m. EST as always. It's always in New York time. We wait for a sweep of the buy side liquidity or the sell side liquidity, so either the high or the low, in the 30 minutes after 9:30. So at 10 a.m., we look for that setup, if not swept before. Then we look for a displacement and a fair value gap at or after 10 a.m. and enter from it, targeting the other liquidity level. So if price takes the high we target the low, and the opposite is also true. If we take the low, we target the high. There is a note that you can use any entry type you prefer. There is nothing in specific that you should follow. So as I said, using fair value gap, using order blocks, using breaker blocks, inverse fair value gap as your entry, it's your decision at the end. Going over some examples here, and from here everything is going to be more clear. So we have the London session right here, and this is 2 to 5, and here we have, so this session right here is starting from 10 a.m. So this is where we look for a setup. If we can see here, what do we see here? The London session was going up, and we can see that price kind of going up. The bias is going up. This is the 5-minute time frame. What do we have here? This is the low of the London session. What do we have here? We have 2 consecutive fair value gaps. We have 2 fair value gaps in a row that are not filled. And this now looks like an inducement. This looks like a valid liquidity level that we can look for a liquidity sweep at. And this is what happened. So price was going up. We can see the high was taken. So there was a high taken, but it was not at 9:30 or 10 a.m. The thing is that price at 9:30 created this low coming into the 50% of those 2 fair value gaps. And this is 1 fair value gap on the higher time frame, just a single one. What happened here is price coming into the fair value gap, and then the displacement showed. So if we can see here, from all those candles, what is the biggest or the most aggressive candles that we can see? It's those 2 candles, this one and this one, especially this one, this bullish candle. It has a change in the state of delivery. You can see that it was creating an order block here. So price going up, big displacement, fair value gap here. We are at 10 a.m. That's a valid entry, fair value gap here. Entry at the fair value gap, stop loss at the low, targeting the other side of the liquidity. So if the London high was not taken, I'll be only targeting the London high. But we created another high that is right here. So this is going to be my target right here. This was about 2 to 1, and it was a winning trade, and price kept going up. So you see how we could see that price was going up. A low of the London session was taken at 9:30. What do we have below to support the price to go up? There's also a fair value gap. What happened is price coming into the fair value gap, creating another fair value gap. What do we know about a fair value gap that is created after price taking liquidity and mitigating another fair value gap? This fair value gap is a high probability. If you don't know about this, make sure to watch my high probability fair value gap video. So we enter here, stop loss here, and take profit here. Another example right here. So we have the London session right here, 2 to 5. And we can see that the low right here was taken by this candle. After the London session, price was going up, created a high, and then started going lower. So big displacement. But if we can see here, what do we notice? Where does price reach and then kind of react from or give a reversal from? It's the London low, which means that the fuel of the market was ending here. There is no more fuel in the market. Where is the fuel of the market now to go up? It's the London low. So London low is taken here. We can see an aggressive move to the upside. Price is creating an order block. This is a change in the state of delivery. And we can see a big displacement that happened after. If we take the Fibonacci from the low to the high using OTE, we can see that the order block is at the 62 and the 79, which is the OTE zone. What happened is price come in here. You could use the order block in this case, and price go to the take profit, which is the high that was created after the London session, which means we are anticipating price to break highs in this case. And what is the nearest high here? It's this one. That's where price goes and actually kept going higher and higher. Now this is the first entry. It's an order block, change in the state of delivery, and OTE. This is 4.8 reward to risk. However, if you were not satisfied with this, the market also give you another opportunity to enter, which is fair value gap right here, small fair value gap, and an inducement. So you could basically enter from the fair value gap after price taking the inducement. Why? Because this is a high probability fair value gap. Entering from here, stop loss below the low, targeting the same buy side liquidity right here. This is a 4RR. That's another huge trade. So 2 trades in this day, 2 types of entry. I'm sure you can find other type of entries, but those are the main ones. Third example right here, London session. Price started going up here. This all doesn't matter to me. I'm waiting for the 9:30 or the 10 a.m. we can see 9:30 also taking the buy side liquidity. After 10 a.m., there was no displacement to the downside except on this leg right here. So price finally started to go lower, and the London high was already taken. So we are above the London high in this case, and it's already 10 a.m. So now it's time to look for a setup. Where are we? Above the London high, which means that we are going lower. We can see that in this leg right here, from this high to this low in the circle, do we see any fair value gap to the downside? So we can see a small displacement right here, and especially right here. You see how displacement is always in a fair value gap? So this is the only fair value gap that we can see on this leg. And what happened? As price going up, we had some liquidity levels here, some inducement. So this was a high probability fair value gap. Entering at the 50% of the fair value gap, stop loss above any high. This is subjective here. I put it above this high just to give some room for price to breathe. However, I know that price is not going to go up. Why? Because there's no other fair value gap here. So there's no reason for price to go up. If it disrespects its fair value gap, mostly it's going lower. So stop loss here, take profit at the London low, take profit done. If you can see, as soon as price mitigate the fair value gap, going lower aggressively. Why? Here's the reason. Low resistance liquidity. Low resistance liquidity all the way here. All of this is a low resistance liquidity right here and right here. So low resistance liquidity is a magnet, and in a low resistance liquidity, your trade will hit the take profit much, much faster. Now, this example will also tell you how to use the London session in your bias, how to identify bias using the London session. So we can see London session is right here. This is the high of the London, low of the London session. And we can see that price was going up actually, going up here, starting at the 10 a.m. You can see that price was going lower. So right here, we could see price taking liquidity from here, coming lower, change of character or market section shift here. But it was before 10 a.m. So not entering a trade here. Price retraced back into a fair value gap here, went lower. And then we have a breakout structure here. So you can see that price is starting to create a bearish order flow. What is this? This is a fair value gap that is created after mitigating another fair value gap. So what is this? A high probability fair value gap. We mark this. We can see price created a breakout structure. So that's even higher now. We enter from the fair value gap, stop loss above the swing high, targeting the London low, which is the sell side liquidity. This is about 5 RR trade, a huge one. And in this scenario also, whenever you get in, 1 candle, 2, 3, 4 candles, and your take profit is hit. This example is one of the best examples that I could found, and this tells you that there's always a context behind your trade. So market structure shift, breakout structure, price mitigating the first fair value gap, prices above the London high, all of those stuff together, they're going to give you confidence to enter your trade. Now, what are some stuff to look at to get a high win rate in this setup right here? First of all, the trade needs to be aligned with the higher time frame bias and the order flow. Second thing is that you want to see the London session as a range or a consolidation, or even if it's not a range or consolidation, we want to see a clear liquidity. We want to see that, oh, the London high is a clear liquidity and the London low is a clear liquidity also. Third one is both London session liquidity and PM session liquidity are taken into the same direction. So if you see that London session high is taken, if you go back in time and you see that, oh, PM session is also taken, the high of the PM session, then that's a high probability. Why? Because we have 2 levels of liquidity taken in the same direction. So that's even higher probability. And finally, the entry between 10 a.m. and 11 a.m. EST is also known as a silver bullet, is a high probability entry. So if you keep focusing on 10 to 11 a.m. entry, that's a high probability entry. Why? Because it offers you the silver bullet entry. That's it for this video. It was a quick video, very effective setup if you know how to use it, if you practice it. You know, it's always the case. If you practice something, you're going to be good at it. If you just take this video, watch it, and then think that you're going to be good at this setup, don't try, because you will not be. This is the reality. If you guys like this type of content, make sure to like, subscribe, and leave a comment to support me. Give me some ideas to post about in the future. This is Molham, and I'll see you in the next video.